All right, guys, so we're going to go ahead and talk about iron condors in this video. And let me go ahead and exit out of that. Okay, perfect. So let's go ahead and get started here. So you can make consistent passive income with iron condors. This is an options trading strategy. And it might sound complicated at first, but in the next video, we're going to run through some live examples in Thinkorswim, and I'll show you exactly how to place a trade like this. So essentially how this works is you're going to have two call options and two put options. So it's going to be a four-leg option. Okay, so you're going to have a call option that you buy. You're going to sell a call option as well. Then you're going to sell a put option and buy a put option as well. So the key here is that the maximum profit is going to be the net credit received or the sell premium from the short call and the put. These are the ones you've sold, since it'll be greater than the net debit of the call and put option purchased. And so essentially the credit will always be more than the debit. Always remember that. And if you remember that the credit received is the maximum profit, okay, because what's happening is, let's say you sell the call and the put option and you receive $3 total premium for selling those, but then the call and the put option that you purchased are only $1.50. So the max profit on that trade will be $3 minus $1.50 is $1.50 times 100, since each options contract represents 100 shares, and you have a max profit of $150 per options contract on this iron condor trade. So the maximum profit will be realized if the stock trades between the short option strike prices until expiration, which means all four options would expire worthless. Now, the maximum loss will be limited and capped at the difference between the bought and sold strikes along with the bought and sold put strikes less the premium received. So what you have here is essentially the difference between the strikes minus the premium, the call strike and the put strike, the bought and the sold, and also for the put option as well. So essentially what you have here is, once again, the net credit received is the max profit. That's going to be found by subtracting the amount received from selling these options versus the amount that's purchased. And if you think about it, we're selling a call option closer to the money, and then we're buying a call option and also a put option that's further away from the money. So that's why it's less, and that's why we can receive that maximum profit, the net credit. And then, of course, we want the price to stay fairly neutral, because if that does happen, then what that means is we collect the max profit. If the stock stays within the defined range that we want it to, we'll collect that max profit, which is that premium that we receive, the net credit, and then all four options expire worthless. That's the best case scenario for this type of trade. But an example of an iron condor, so let's say you're a trader and you believe that XYZ stock will not move much in the next month. So the stock currently trades at $100 per share when you decide to implement an iron condor trade. Okay, so let's say you sell one with a $105 strike, and then you get $3.50 in premium, or $350 for that option. And then you buy a call option with a strike price of 110. So that's the further out of the money option. You're always going to be buying that type of option. Same for the put option. It's going to be further out of the money than the closer strike, which is going to be the one that you sell. So the 105 strike in this case. But in this case, it costs you $150, right? $150 for that option to buy. So you take $350 minus $150, and you get $200 total, or $2 in premium for the option. So then you also decide to sell a put with a strike of 95. It's, once again, if the stock's going down, that's going to be the closer strike price. And then you receive a premium of $3 per contract, or times 100 is $300. And then you simultaneously buy a put with a strike of 90, and that costs $1 or $100 per contract. So the net credit on these two legs would be $200 total, or $2 for each contract, if you're, depending on how you're looking at it on the quotes, or if you're looking at how much you would actually receive from the option. So the total net credit, therefore, is going to be $400 received, $200 from the call options, plus the net credit from the put options. So that is the maximum profit, and this will be earned if the stock trades between 95 and 105 up until expiration day. So we don't want the stock to go below 95, and we don't want the stock to go above 105. Otherwise, we start losing money. Now, you can still make a reduced profit in this situation, and there's very specific trades that you could take a look at, and we can do some live examples perhaps in another video or something like that. But nonetheless, what you're looking at here is if the stock does start to trade beyond those sold strikes, right? The sold put at 95 and the sold call at 105, you essentially start to lose money. But you do have a max loss on this trade, and the reason for that is because that's your protection from the bought call strike and also the bought put strike, the 110 and the 90. So it does act as a buffer, and it maximizes the loss. So there's going to be a max loss as well, and that will be defined when you enter that trade. But in this case, it's going to be the difference between the strike prices, right? And so we could run the numbers on that. But what I want to do in the next video is actually go through a live example, and I'll show you exactly what I mean, because you'll see that Thinkorswim actually calculates everything for you and shows you exactly how much your max loss is. So you can always double check your work and go from there. But to summarize here, when we're looking at iron condors, it's going to be a profit, off a trade of low volatility and a stock price that is expected to remain stagnant for the time until expiration. So you want a stock to pretty much remain flat. It can move within that range once again. So in this case, we want to make the max profit, the 105, and the one that we sold here, the 95. If we can remain in that range, then we'll get that max profit. But if it starts to move out of that range, then you'll start to lose money. But the max loss will always be defined and will occur if the stock finishes above the bought call strike or below the bought put strike. And so we don't want that to happen, right? Iron condors can be beneficial and lucrative in flat trading stocks that have been trading within a defined range for several weeks or several months and are not expected to make a large move to the upside or downside until expiration day. So if that does happen and you're expecting not really a big move in the stock price, iron condors can be the way to go. But hopefully this makes sense, guys. Now in the next video, like I said, what we're going to do is actually take a look at some examples in Thinkorswim, and I'll show you exactly what I mean when it comes to iron condors and how easy they are to put into Thinkorswim. Now, if you ever have any questions and you do have a TD Ameritrade account, they are actually able to help you. They have a trade desk and customer support who can help you with these types of trades and setting this up. But nonetheless, it's very simple. I can show you how to do it on Thinkorswim in the next video. We'll go through some live examples and we'll actually calculate our profit and loss on the trade and go from there. Anyway, guys, thanks so much for watching and take care.